What's going on, everyone? Welcome to Common Sense Living. So, in today's video, I want to talk about some recent comments that came out from Jerome Powell around interest rates and inflation. So, Jerome Powell recently said that it was definitely possible that the Fed could begin cutting rates before they reach that 2% inflation target. Now, he did reiterate in his speech or in his comments that there would be no rate cuts this year, but I think we're starting to see a little bit of the writing on the wall. And for me in this video, what I want to focus on specifically is kind of what this means, what we can expect, and how this is going to affect gold and silver prices. Now, I've been saying for quite a while on this channel that I believe there's going to be a new inflation target range. It's 2% traditionally, it's been 2%, but I think it's going to be more in that 3 to 4% range. And really, that 2%, it's an arbitrary number in terms of how the Fed and other central banks arrived at this number. Now, in the past, when there's been periods of 4 to 5% inflation, for example, late 80s, early 90s, 70s, and obviously we had high inflation in the 80s, it's important to remember that during those times where we had higher inflation, we also had positive real interest rates. That's something that we don't have now. And I think that's something to keep in mind why it's so critical that we don't settle into this 3 to 4% inflation range that's taking more people's money every year. So again, positive real interest rates, if I have a CD, if that rate is not higher than inflation, I'm technically, well, I am losing money every year. Now, you didn't used to see that 10, 20 years ago when there was positive real interest rates. Now, why might this happen? Why might they just settle in? I personally think that we could enter a deep recession at some point. It could come about super quickly, and unemployment might shoot up drastically. It would most likely be reflected in other areas than unemployment because I don't think that that's an accurate statistic anymore. The way it's measured, they should be measuring with other types of statistics, other ways. So spending though is something else that could really drop. We could see GDP come down and the Fed might be pressured, they might cave and really just decide that that 3 to 4% needs to be the norm for a while. They may come out and say that they're essentially giving up the fight until the economy rebounds. Now, now, another reason is the political aspect of why we could see temporarily 3 to 4%, or we could see permanently 3 to 4% inflation in the economy. And this is really an interesting one to examine because the Fed, they might be told indirectly to stop raising interest rates later this year, really get the economy moving. But at the same time, they could be told, not to do anything because the White House may have that idea in their mind that, hey, if we bring inflation down, that's something that we could sell in the 2024 election year. So it's really something that'll be interesting. Earlier this year, I was convinced that they definitely would have been cutting rates by early 2024, and I still do think that it's most likely that's going to happen. But in a way, I think that they're going to probably hold off as long as possible. And this is really because incumbents, they rarely win with a bad economy. And the Fed is definitely not apolitical. It's definitely, the government definitely has the ear of the Fed, the federal government. Pressure just might be too thick from the White House, whatever they decide to start telling them. So, what does 3 to 4% target inflation mean? It's really going to keep hurting the average Joe and Jane. Every year, as inflation rises 3 or 4%, we can expect real wages to keep dropping. And we know how bad that is. If you just look at the median price of a home, what the median price of a salary is today, it's no wonder most families, the mom and the dad, has to work, unlike 30, 40 years ago. Now, there's a belief that eventually companies will come around and give 3 to 4% raises on average instead of 1 or 2% or nothing like a lot of companies do. I don't believe this has happened, will happen. Companies are motivated, especially public companies with shareholders. They're motivated by that profit. They're not motivated to do anything else except possibly follow specific political agendas and ideologies. Now, another effect that was mentioned a little bit earlier was real returns are going to become harder to get. So if I make a 7% return on an asset in a given year and inflation is now 3 or 4%, then my real rate of return is just going to be 3 or 4% instead of 5 6% real rate of return, which we've kind of seen the last 20 years. And just talking about the bond market briefly, if interest rates, if they do come down, bond prices, they're going to increase. So since 2000, on the 10-year bond, yields have been essentially 4% or lower. And essentially, with 3 to 4% inflation, there's really going to be no sort of benefit. Those yields are going to have to go up. So we'll see what kind of happens there. That's all I got for today. Comment, like, subscribe. Thanks for watching.